Hello everyone and welcome to Staying Ahead of the Curve. I'm Jeff Snyder, Vice President, Senior Consultant with Cammack Retirement Group. And today we're talking target date funds. I'm joined by the Chief Investment Risk Officer for MFS Investments, Joe Flaherty, and Denise Burns, Chief Investment Officer for Cammack Retirement Group. Guys, thanks for joining us on the show today.
Thanks for having us.
Thanks for having us, Jeff.
So clearly we're here talking about target date funds. They have, since the passage of the Pension Protection Act, we have seen a proliferation of assets flowing into these asset classes. So needless to say, they're very popular. And Joe, I want to start with you. There are some common myths and misconceptions that many plan sponsors have. And I'm wondering if you could just comment on that as you're out talking to plan sponsors and thinking about these products.
Sure, I'll touch on a few. I think there are some areas where we spend maybe a disproportionate amount of time focusing when in fact they don't make a material impact on the client experience. First is maybe the whole passive versus active argument. At the end of the day, there is no such thing as a passive target date fund. You're making active decisions on strategic asset allocation, active decisions around the glide path, active decisions around fund selection, active decisions around how you rebalance. So this whole notion of a passive target date fund doesn't really make sense. We spend a lot of time talking about tactical versus strategic. Let's face it, making tactical decisions are hard. Trying to determine when to get in or out of equity or fixed income markets is not easy. If you can do it 60% of the time, you're really good. Unfortunately, in target date space, the number of levers you have to make tactical decisions is limited. And so it's very hard to do. And I think Morningstar has done some work and has shown that people don't tend to do it a lot because they recognize it changes the risk profile, creates the opportunity for negative surprises. And so there's not a lot of that actually takes place. And I think there's some selective memory around pinpointing specific situations where plans did it, when in fact the overall effect is pretty marginal. The third area I'd focus on is open architecture versus proprietary. At the end of the day, there's tremendous appeal to being able to take best in breed in every single asset class, but selecting that best in breed takes a lot of work. And I think, again, there have been studies that have shown it hasn't really made a material difference. The final one, I'm going to kick it to Denise because I know she's done some work on this, but the whole notion of to versus through gets unwarranted attention.
That's great, Joe. Denise, I want to bring you into the conversation. Joe talked about some of the misconceptions, but as the Chief Investment Officer and head of the investment team for Cammack, you and your team are out there in the marketplace talking to plan sponsors about these products. I want to get your perspective on things that plan sponsors are thinking about.
Yeah, and most of our clients use the target date as their qualified default, we put a lot of thought into the process and talk to our clients. One of the misconceptions is that to, for instance, versus through, and using that as your analysis tool. The perception is that the to target date funds are more conservative and the through target date funds are more aggressive, but clearly that's not the case. We look at the entire glide path and you can find some to target date funds that are more aggressive than through target date funds. We also look at their preference and what their clients, what their participants are like. We look at plan demographics. You know, if a client, for instance, has a huge population of employees that are low paying and this may be their only assets at retirement, we tend to recommend something a little bit more conservative. So we really do look at the plan demographics and we look at the performance and the characteristics of the target date providers.
Joe, you know, what's the role that a diversified product mix has in a target date fund portfolio?
Well, I think diversification brings a couple different things. One, the idea of bringing less than perfectly correlated assets together provides an opportunity to create more efficient portfolios and thereby creating portfolios that can reduce the risk to the client. Why that's important is if you can create a lower volatility stream to your returns, you get higher compound rates of return. So volatility creates a drag. The second thing I would say, it's not fully appreciated, but if you're an active manager and you're thinking about alpha generation, even if you're dealing with segments of the market that may be fairly highly correlated on an absolute basis, those active return streams don't necessarily need to be. And you can create better diversification and more consistent alpha to the end product.
And Denise, you know, obviously evaluating a product like MFS, you've got to understand the underlying asset classes and be able to articulate the differences between this particular product versus the other products. Can you talk a little bit about the process to kind of peel back the onion, if you will, on these types of products?
Well, it's not just the glide path, and we also look at the individual components of the target date funds. For instance, the MFS portfolio managers, we like to know what their philosophy is. We understand their philosophy in constructing the target date, but we want to make sure that the individual components also are doing what they should be doing. So we regularly meet with the portfolio managers of the target date itself, as well as the different funds within the target date, and look at are they achieving their objectives as we see.
You know, my role as portfolio manager is very similar when I'm dealing with the underlying funds within our target date platform. And I think one of the things that we sometimes don't talk enough about is risk management and the risk process. If we're spending a lot of time building efficient diversification, we're spending a lot of time constructing a glide path with specific risk profiles, we're spending a lot of time on fund selection, we should spend an equal amount of time making sure that every component of that portfolio is doing what it's supposed to be doing. We're delivering to the client what we're intending to deliver. And that's where I think, you know, my role, which as far as I know is unique in the industry, as Chief Investment Risk Officer and Portfolio Manager, I not only have transparency into all of those underlying funds, but more importantly, I have the ability to influence positioning and behavior to make sure that they are consistent with the style and the reasons that we've placed them in the portfolio in the first place.
Denise, you're out talking to clients about these products, and it's not just enough to select a product and then kind of forget it. Like we tell participants, it's the Ron Popeil said it and forget it, right? But you've got to come back potentially year over year to reevaluate, to affirm that it's the prudent decision.
Well, our methodology goes away from the to versus through. We've done a lot of research in 2013 and then again just at the end of last year. And what we found is that where it really matters in terms of risk in the target date is in those years where there's more financial capital than human capital. This is the time period where people are getting closer to retirement. They have more assets in their retirement plan. And this is the time that we think is most important in terms of the amount of risk that you're going to take. So what we do is we kind of categorize the different target dates in that time period, which is when the participant is anywhere from 45 to 65 years old. So we have 6 different categories, and we group the target dates dependent upon their equity exposure during that time period.
Joe, I'm going to bring you in here. What are some of the things, the criteria that FAs, financial advisors, and plan sponsors should use when evaluating these products? Denise articulated the Cammack vision, but you're out in the field as well, and you're talking to FAs and other advisors. What are some of the criteria you think are important to evaluate?
Yeah, well, let me first say I agree with Denise from an evaluation standpoint. It's exactly where we concentrate from a design standpoint. We think those later years are in fact the areas where obviously balances are larger, time horizons are shorter. There's actually more differentiation among glide paths in those later years than in the early years as well. So we place a considerable effort on getting that part of the glide path right. You know, I say in terms of performance evaluation, we often talk about their long-term investments. They should be thought of and evaluated over a very long time horizon. And I think that's fair, but you need to be thinking about a cycle, not necessarily 40 years. So certainly, if I'm in a 2020 fund today, I don't have a 40-year time horizon. So we can learn a lot looking at not only the cycle peak to peak or trough to trough, but various points in the cycle. We can learn a lot about what a 2020 fund participant might experience today by looking at what 2010 participants experienced maybe through the financial crisis, and emphasize the importance of that principal preservation component to a portfolio in those later years.
And so time horizon is important.
Exactly.
And Denise, from your perspective, the traditional review of these types of products is really a short-term perspective. And I think what you're articulating, what your team kind of goes through, the process you go through, is that longer perspective that kind of Joe is articulating.
Yeah, clearly, and we look at the target dates that our clients have regularly in terms of performance, but every year we also go through the target dates and make sure that what's selected is still appropriate for their participant base. And there we will compare the target date to other target dates too. Most recently, you've seen a lot of interest in passive target dates. And I think that's going to reverse now because we're in an environment where price earnings ratios are much higher, market valuations are higher, and I think people will I think we're going to go back to an investment time period where people will be more selective and it'll be more of a stock picker's market. So I've been advising people to kind of look at active management in that light as a way to control risk in a highly valued marketplace.
Denise, you talked about the data. When you're out talking to clients, you're looking, on a plan-by-plan basis, you're kind of looking within the plan ecosystem to see how participants are handling, managing the plan. Are they leaving the plan at age 55? They're remaining the plan at age 65? Is that an important criteria in terms of decision making?
What we found in our initial research in 2013, most of the plan participants were leaving the plan at age 65. What we found now, a few years later, is that they're actually staying in the plan. So it's important to see, what the allocation is after retirement too, because people are more comfortable with target dates. It's clearly the default for a lot of different plan sponsors. There's more participation, and we're seeing more people that are actually staying with the target date. So we will continually review it. We'll also look at other things which are important in the selection of the target date, contribution rates, because you can have a great target date, but if your employees are not contributing enough, it's really not going to help them get to retirement.
And Joe, I want to bring you in here around data. I mean, you have a wide array of clients from public sector to corporate, tax exempt. I presume that you're looking at the data as well. You're kind of querying the clients and kind of figuring out how are people using our funds, and do we need to make any tactical or strategic changes to our asset allocation or our glide path?
Yeah, I mean, one of the things that we think about is, a typical approach in this space is to identify a representative or average participant and build a glide path that's optimal for that average. And what we found in looking at the data is there is no real average that's representative of a majority. In fact, if you look at the distribution along all these various dimensions, whether it's savings rate, balance, loans, whatever it might be, very few people look like the average. So what we try and do is take an approach that we think makes sense for the majority of participants. And what that means for us is emphasis on capital appreciation in those early years and greater emphasis on preserving whatever we've gathered over our lifetime in those later years. And we think that stands the test of time and is appropriate for the majority of investors.
Denise, Joe, thank you so much for joining us. I wish we could spend hours upon hours talking about target date funds, but we're going to have to leave it here. Thanks, guys.
Thanks, Jeff.
Thanks, Jeff. Appreciate it.